Now is when we turn to the international market and we want to look at what is happening abroad, what are things that are shifting. And in segment one, we talked about how the Middle East is importing a record amount of fuel oil and diesel from Russia, and that's allowing them to not only refill Fujairah, but also consume the Russian product internally, export the product that they're making in their own refiners locally into the European market, and trying to close that gap because Europe continues to be in those dire straits. As we talked about last week, when we look at the ARA data, where you have gas oil at all-time lows, seasonally adjusted, obviously, but still all-time lows. Then when you look at other points, you have gasoline still at near all-time highs, and that's going to have to be the balance. But one of the things that we talked about last week was that India's new policy to ensure there's enough fuel in the domestic markets are expected to lead to only a modest decline, because so far the demand or the price in the market for middle distillate and diesel in general is essentially covering what has been the windfall tax that has been asked of exporters to keep things internally. But despite that, producers still stand to profit more by selling products overseas rather than domestically. So gasoline and diesel buyers across Europe and the U.S., especially, again, the Atlantic Basin, coming into PADD 1 and obviously Western Europe, continues to pay top dollar, and that's really to replace that Russian crude, that Russian product, which is then coming from both the Middle East as well as from India. So it's what this will do is essentially cap where we are. We're instead of seeing a gradual increase and more guys trying to pivot into the international market, that'll keep some of it there. But again, you'll see this flatlining in terms of where the product sits. Now I think it's important to look at the commentary that has now come from where the world oil demand is. And again, oil demand in general is a very difficult thing to nail down. This is not an easy case. There's a lot of competing factors, and there's a significant amount that resides on the consumer. And as we know, globally speaking, the consumer is a very fickle bunch. You can see all the data. They can tell you that they feel terrible. Just in the U.S. alone, the OECD nations, consumer sentiment is at the lowest it's ever been, but we're still getting fairly stable buying. It's slowing. There's pressure on consumer consumption, on retail sales. But if you were to look at the expectations and the sentiment, you would assume that people are living as hermits. So again, there's that balancing act of what do people say and what do people do. But as the pressure mounts on the real wages, on the tapping credit, because even though credit missed estimates in terms of additions, we're still at a record amount of credit being used in the United States. So how much of this crude oil demand is going to continue? And this is where I want to get a bit nerdy in terms of what makes up 101.72 million barrels a day in Q1. And it is not all oil. It is not all crude black oil. There is NGLs in this. There is liquids in this. And the thing that we've been talking about is liquids demand is going higher. So when you look at liquids demand, when you look at liquids flow, when you look at petrochemical facilities coming online, the amount of plastic that goes into EVs and the other types of green technologies, there is a lot of demand when you're looking at it from the perspective of new growth from that area. But when you look at LPG and LNG in terms of taking market share, it's taking market share from diesel, from high sulfur fuel oil, from all of these essentially middle to heavy distillates and residual fuels, which is, even though that's increasing the use of propane, it's decreasing the use of diesel. So you have a little bit of that balancing act. Now, we do think that LPG demand outpaces the reduction in diesel, so you will get growth. The problem here is we do expect to see a bigger step down in diesel and gasoline consumption through 2023. Now, the reason why we say that is because we see that slowdown in terms of demand when you're looking at the macroeconomic pressure front. We see inflation, we see that there is a recession that has already begun and that is going to continue to hinder where that growth is going. Now, when you look back in time, and we've used these charts before, like the U.S. for an example, when you look at the drop in 2008, our oil demand fell 8%. So we're not going from 100 million barrels to 70 million barrels a day of demand. It's just, I don't think we get and crest much above that 100. Now, we will get LPG, we will get some of that growth, and that's going to carry us and buoy some of this, if you will, some of that drop. But when you look at the black oil consumption, the refining consumption, we see that as coming under pressure, which is going to keep us, we think, below these numbers, especially when you look at Q4, which is showing 105.4 million barrels a day of consumption. I think that is a very lofty number that is unlikely to get hit, because if you just look at the demand cycles, if demand hits those levels, well, then you should see a fairly sizable supply response. And we're going to talk about that in a minute, because you might be sitting there and saying, well, there's going to be a muted supply response, which is true, especially given what is happening with Russia and what we showed last week when we balanced in terms of who isn't producing. West Africa and Russia are the ones that are really driving that reduction in OPEC production. But when you look at the Middle East, they've been investing money, obviously a little bit quieter than they normally would, just because if you just look at the last decade, if you said you were investing in more oil, you would have been shunned. So what do? They Saudi Arabia and Kuwait and the UAE I think were very good at gamemanship of saying, well, we're going to have renewable conferences and green conferences, and we're going to host them, while quietly continuing to, again, invest in their local shale, their local production. Why? Because it's state-owned entities. They don't have to tell anyone anything. And if you talk to the OFS guys, they're like, yeah, we've been active. Obviously, it wasn't been gangbusters, but there's been activity, which is why there is a certain amount of growth that can happen there. It is muted. A lot of this is tied up in Russia, and unless we sit there and Russia leaves Ukraine, or if everybody balks at the price and they decide to cut a deal with Russia, you're going to see that production going away, which again is going to lead to some of these shortfalls, which is going to keep prices a bit sticky. Now, again, we don't think the JP Morgan number of 380 million barrels a day is possible. I mean, there's always a chance nukes hit all these locations, but unless you have that, highly unlikely. Though to see a drop to 50 or 60 is a bit tough, just given, yes, we're getting that demand drop along those cyclical lines, not so much structural, but cyclical declines along the recession front. But that lack of storage in some of these key areas is, again, going to keep refiners active, because typically if refiners are seeing their crack spreads come down, and they've come down 20%, over the last 2 weeks, but 20% from all-time highs. I mean, so 20% is still a drop, but it's still high over the last decade. So there's still incentive for refiners to run. There's still a shortfall of middle distillate, which again is going to keep this level. And again, I'm not saying that we're going to 90 million barrels a day of demand. I just think that we're going to be much closer to that 98 to 100, and maybe that 101. But again, I just don't see this as a likely outcome, especially as we go into the back half of 23. So again, it's OPEC's first 2023 outlook, and I'm not, the outlook shows no relief from the oil squeeze. Again, demand growth to surpass supply by 1 million barrels a day, but demand growth is where is it showing? Where is that shift? And that's why it's really important to look. So when you look at first oil market outlook for 2023, suggests no relief for the squeezed consumer, with more crude needed from the group. To fill the gap, OPEC would need a significant hike production, but members are already falling short. But again, where are they falling short? Which is Russia and West Africa. And West Africa has been struggling to sell their crude. So they've been struggling to sell even a reduced rate. But there's also products. There's also what type of products. So when you look at the differentials, and especially when you go back to Saudi OSPs, you had a big increase in one OSP and a big decrease in another, or at least flat, that has been opening that arb between light crude and heavy crude, which is again putting some of that pressure in. So then when you start looking at production, here you can see that there's been an increase. Saudi Arabia's increased production by 159,000 barrels a day, Kuwait by 29,000, Iraq by 17. And then when you look at the UAE by 39. So you are seeing some of those increases. But then when you start looking at, obviously Libya has their issues. There's now more problems in terms of political peace or political stability, with one entity trying to kick out the NOC. So we don't see that going much above 600,000 barrels a day. But when you look at that growth side, it continues to be a bit, slow. So production increased by 234,000 barrels a day. But it's important to keep an eye on the production of the four core countries of Saudi, UAE, Kuwait, and Iraq. The argument that there has to be some bullishness because OPEC is not able to meet its announced target. Well, but what is demand doing? And that's where if they don't meet their target, well, these guys are meeting their target. The other ones that have seen pressure on their buying because Russia's taking market share and China's sitting on a glut of crude is again going to shift some of these dynamics. So global oil demand will, according to OPEC, will expand by 2.7 million barrels a day next year, bolstered by growth in emerging economies. But emerging economies, you're watching protests. You're watching these pressure points in terms of food price, gasoline price, essentially petrol prices, which is capping some of that growth, which again is makes it difficult to see that, because we see developed markets essentially just hitting those lows but still staying fairly stable. The emerging markets is actually where we see the biggest decline. So again, it's difficult to see that we're going to see some of that backdrop. So to balance supply and demand, OPEC would need to provide an average of 30.1 million barrels a day in 2023, which is 1.3 million a day more than the cartel's 13 nations pumped in June. OPEC has been reviving production halted during the pandemic, obviously with the final tranche scheduled for next month. Yet the group is pumping below target, but Angola and Nigeria are the ones. Now, Nigeria has had some issues with some of their oil leaks. They're trying to get that under control. But even if that was under control, they don't have the buyers that they normally do, as Russia continues to be that bellwether. Now, here's another interesting one. So the annual liquids production change. Now, I think the key word here is liquids, not oil, liquids. So you're looking at where the growth is. Now, we did a report on refracs, and we did a backdrop on where refracs are in the U.S., and we think that there is an opportunity for a significant amount of wells that would be up for mechanical diversion and the ability to increase some of this production without going back to the duct side, without new wells, but obviously maintaining production, but also increasing their refracs, and because we do see growth in liquids demand. So again, there's going to be growth in liquids that will help offset the drop in oil demand. But the U.S. is actually in an interesting place to meet that. So we don't see a huge increase. We have an exit rate for 2022 of 12.2 million barrels a day. If we had to put an oil production exit rate for 2023 already, it would be closer to about 12.7 million barrels a day, which is not a million barrel a day increase. But when you look at the liquid side, on the condensate, on the LPG front, we do think that there is enough to create and to fill some of this void, because we're being paid to do it. And what does the U.S. do well but arbitrage and invent new ways to capture the arbitrage? And so we're revisiting these refracs with some of the lessons learned. And again, refracs don't work in every well. They don't work in every rock. But there are very specific points that are up for refrac, and we can increase some of that, some of those yields. So the estimated demand growth in both years is 6.1 million barrels a day, which is OPEC plus non-OPEC production plus SPR plus OPEC NGLs. And when you look at it, it's much larger. So when you look at the demand growth, again, there's because supply is limited. When you look at what Russia can do, you're going to need a bigger demand response in order to balance things out, and that takes longer, which is why we do think prices remain fairly sticky at this point, capped, but sticky in terms of where we are right now. And here's another interesting one. Crude oil exports from Saudi, crude oil exports during the first 10 days in July averaged 8.42 million barrels a day, up by 1.93 million versus the full month of June. And you would think that, well, they have to keep some of this there for their local consumption based on, the fact that it's summer and that they're going to have to keep the air conditions running. But as they're importing cheap product from Russia, they can then export more and capture that arb. So again, that's where you're seeing these shifts. So even though Russia's coming down, they're still finding markets. The market is still clearing. It's going to find a price, but it'll clear. And that's where we're getting some of these movements. So when that's also putting some pressure on the Brent versus Dubai spread, which is now closer to about 1050. So again, you're starting to see that pressure come through. And this is the same thing that happened the last time Saudi Arabia gunned their OSPs because of Brent. You saw all of a sudden this came down. Again, still elevated, but when you factor in the OSP price, it was still very expensive. And again, these are some of the pressure points that we're going to be watching. Crude oil on the water, it will take out the 2020 highs just because 2020 is coming down. A lot of staying power for 2022. Again, Russian crude is longer on the water. Well, even if it's not in transit, it's going to be sitting in floating storage, and so you're going to continue to see a lot of crude on the water, which is going to keep this elevated. Now, crude oil in transit, which is setting a new all-time high, which again is what is going to be the biggest driver. As Europe buys more from the Middle East and West Africa, the U.S. buys more from West Africa and the Middle East, Russia sells more into India and China. Remember, India is buying fivefold more than normal, which is keeping these transit numbers bid. Floating storage came down a bit, still slightly above where we were in 2021. But you can see that there was a drop in 2021. We continue to see that increase. Now, the problem this time is China has a significant amount of crude in storage. So are they really going to continue to be active buyers, or are they going to start to try to work off what is in storage, what is in floating storage? But we think that there's enough opportunity for them to try to create this arb, which is going to keep us fairly fixed to 2021 levels. And this is what we were talking about, the Asian floating storage. We think it just kind of holds this 2021 level. There are more shipments coming up that will get there. There are some new bottlenecks that are starting to emerge that will put some of that into friction. Now, when you look at Shandong activity, we're back to 2021 levels. But this is on the Shandong side, or the teapots, which is sitting at about 69.2% utilization rate. But when you look at 66 Chinese state oil refiners, they're expected to be flat month over month, and they were already at a very low rate. So that's, again, going to put some of that pressure into, well, how quickly can they go through that product that crude? And when you have these refiners and the SOEs sitting at about 75% capacity, that's going to, again, leave that crude in storage, create that problem. And we're not seeing a huge surge in demand internally based on slow economics. And again, that's going to keep things a bit fairly depressed, which is going to leave more crude in the water because they're going to try to work through some of that excess in their storage. West Africa starting to bounce back up. We are starting to get some cuts to pricing, and again, some of them from elevated levels. But if they want to clear this crude that's starting to build back up in floating storage, they're going to have to get more aggressive. And given the inherent buyers with the fear out of Libya, some of the noise coming from CPC, which has so far been alleviated in the near term, that's going to keep Europe a bit active. While China's supertanker is starting to move back up, but we expect that to be a bit depressed just given where they are on the internal storage front. U.S. products, gasoline dropped 175,000 barrels a day, still well above the 5-year. We think that, as we've been saying, they're going to stay just above the 5-year average. Distillate had a nice spike of 239,000 barrels a day. We think that comes back down, stays just below where they were on that 5-year. And then propylene had a drop of 131,000 barrels a day, but still 463,000 above the 5-year, going to stay very strong. Crude exports increased 412,000 barrels. just over 3 million. We think it stays at an elevated level, and again trending closer to that 3.1 to 3.2 as we do have more purchasing both from Europe as well as from the Asian theater coming from both Japan and South Korea. So when you look at gasoline exports, again, just coming right back into normal, we expect it to be at the top end of the cloud as more flows down into the Latin American markets. Distillate broke out, but again, we expect it to fall back within that 5-year average as we continue, as the arbitrage continues between what the coastal refiners can do and what they're able to export. Ethane exports, as you can see, still holding towards the highs. We expect that, again, speaking to the NGL liquids front, we expect this to continue to be a very robust market and a lot of this heading into the Asian markets. And when you look at crude oil exports, again, staying strong, but we always, as we said, like to look at the 4-week rolling average, which sits at 3.147, and we expect it to stay, again, at that 3.2, 3.3. There's a lot of that demand that remains, not surging back up, but again, steady demand going into Europe and Asia, and especially into Europe as Libya and CPC get thrown into question, and there's a lot of concerns around there. So when you look at propane, propylene, exports continue to move back up and staying at all-time highs, and we expect that to remain the case. And then when you start looking at Russia's, again, the last to put their loading schedule out there. So we expect them to try to export over 4 million barrels a day again. In July, Norway stepping back up, which is normal for this time of year. Angola, Nigeria stepping down slightly. Again, even though they're stepping down, you're still seeing a lot of that floating storage. Again, some of that push and pull, while Libya continues to sit at just over 600,000 barrels a day. Now, Nigeria's Forcados and Bonga crude for August loading were offered at $13.50 more than dated Brent. But that drops from above $14. So again, you're going to continue to see some of that pressure to the downside as they try to, again, find those buyers because there is that demand coming into both the U.S. and European markets. European crude storage, as we've been saying, we expect it to kind of sit around this level, and we don't see much changing here, which is right around where it was in 2021. But now when we look at Fujairah had a small drop of 210,000 barrels a day, still over 22 million barrels in in storage. So the buildup in light distillates continues to be the case. So gasoline and naphtha and obviously light distillates had an increase of 402,000 barrels. Asian gasoline complex strengthened in the second week of July due to some of the increase in demand from Indonesia and Malaysia post the Eid festivities, but again, that's more of seasonal. That'll come back down. Moving forward, demand for road travel continues to recover as easing COVID restrictions happen, but it continues to be at a fairly muted pace, which is leaving some of that brunt in the market. And then at the same time, even though some of that demand is coming up, there's also that supply response as refiners try to target that middle distillate side, which is why we've been saying we expected middle distillates to remain bullish or remain at this low end of storage while gasoline continued to build. Diesel middle distillate side dropped 133,000 barrels. The gas oil complex continued to show signs of weakness, though, as the second week of July, as refiners within the region continued to maximize gas oil exports, capture those still higher cracks, but those cracks are starting to come down. But because the storage is at such a low level, it still is incentivizing. And as they try to maximize middle distillate, you inherently create light distillate. Stock of heavy resid dropped 479,000 barrels. That's down to it's still standing above 12 million. So supply of heavy resid in Asia has tightened due to lower production as regional refiners maximize output of middle distillate. So again, you're starting to see that balance of targeting that middle distillate side. But because of some supply issues on inclement weather, you're getting this bounce back and forth, but we still expect heavy disti to remain elevated. When you look at the time spread in Brent, still remaining supportive, but coming down a bit now to 335. Again, we expect this to continue to support that back into the curve on the Brent front. So then when you look at North Sea, here you can see that things have come down a bit, but again, just kind of that balancing act between what is onshore, what is offshore, and what can be sold into the market. As Norway picks back up, the focus is going to be to try to get this into the market. Middle East flows staying fairly stable in terms of floating storage. You're starting to see an increase out of Saudi Arabia. Some of that's going to come from floating storage. Some of it's going to come from onshore storage as they try to balance, as they take in some of that cheaper Russian product, keeping those flows moving, especially into Europe. While Europe, you continue to see floating storage remaining a bit elevated. And again, that supports our view that we're going to see some of this go from floating onto onshore storage, keeping things fairly fixed as to where they are internally within the European, Northwest Europe. So that's what we have for you today. If you have any questions, you can find us on obviously Twitter or in the comments section. We hope this was helpful, and we hope you have a great rest of your week. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.